Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to go through a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship. There will be a non-controlling interest. That means that the parent is not owning 100%, but does own a controlling interest over 51%, therefore having a non-controlling interest. There will also be an intercompany transfer of equipment and land. That's our major focal point for this consolidation. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We got the information on the left. We're going to enter that information into the blue area on the right, where we got our worksheets, and then we've got our journal entries, and then we have our consolidation worksheet. Let's go back to the data on the left, which says P purchased a percent of S voting common stock on January 1st, 2000 X0. P is the parent, S the subsidiary. Purchase took place in 2000 X0. Percentage of stock that was purchased 70%, therefore non-controlling interest will of course be 30%. Cost 157.5 for the purchase of P, 70% interest in S. Non-controlling interest fair value, the non-controlling interest of the fair value of the non-controlling interest at the point in time of the purchase, 67,500. Net assets at the purchase, meaning assets minus liabilities, book value, or equity section. Assets minus liabilities equaling equity, 174,000. Fully adjusted equity method is used by P to account for their investment in the subsidiary S. We're going to consolidate as of 2000 X5. So that looks like 6 years later, because it happened in January 2000 X0, and we'll consolidate 6 years later. Book value and fair value of assets and liabilities are the same, so we don't have to deal with the revaluation of the assets and the liabilities at the point in time of the purchase. There's going to be an impairment loss on Goodwill that happened in 2000 X4. So that means that when we do the Goodwill calculation, we will find that there is Goodwill. Then that must mean that there was Goodwill involved in the initial purchase, and then it went down. There was an impairment because it could last forever, but it went down in 2000 X4. That's not the current year we're working in because we're consolidating 2000 X5. So that happened, that Goodwill impairment happened basically in the prior year to the year in which we are currently performing the consolidation. And then in January 1st, 2000 X2, S sold land to P. So now we got S is the subsidiary selling to P, so that's an upstream sale. Land sale was sold for 19,000, the cost being the 10,000. And then in January 1st, 2000 X4, P sold machinery to S. So now it's going from P to S. That's a downstream transaction, parent to subsidiary. P purchased it 5 years ago, and then earlier for 58,000. So we're going to say, hey, this is what was originally purchased for 5 years ago by P. We're just going to use a straight line method, which is going to be 10 years and depreciated over 10 years. And that means 5-year depreciation happened before the sale, and we're just going to take the other 5 years and depreciate it after the sale, and that's how we're going to use the straight line method for depreciation. Useful life 10 years, sales price. Okay, intercompany receivables and payables 5,000, meaning there's a receivable on the book for say P, there's a payable on the book for say S that we're going to have to reverse out. All right, so let's start back up. We're going to go to our little worksheet that we work with up top. This is our standard worksheet that we will do to adjust the first entry that we'll typically have. And so we usually start off with the first entry of the kind of net income that we will allocate between P and the non-controlling interest. So we'll think about an adjustment to that worksheet. So let's just start looking at that starting point. So I'm going to say, all right, usually we start with, I'm going to say negative of, and I'm picking up the information from our worksheet. And I know we haven't looked at it much over here, but our worksheet has P and S that are their trial balances. Here's S's trial balance as of the current time period. This is the net income for S as of this point. Revenue minus expenses being income, not a loss, income 45,000. Typically, we're going to take that 45,000 as part of our first journal entry and use it breaking it out between the controlling and the non-controlling interest, meaning we're going to take the 45,000 times the 70% for the controlling interest, and then the 45,000 times, I'm going to do it this way, times 1, I'm going to say 1 minus the 70% or the 30%. And of course, these two add up to the 45,000. So then we're going to have an adjustment we're going to have on this, and I'm going to call it the extra depreciation down adjustment. And that's going to be a result. That's something we want to be considering whenever we have a sale like this happening with regards to the property, plant, and equipment, because then there's going to be depreciation involved here. Note this is different than what we've seen in a prior presentation where the exchange happened in the current year. So you can kind of compare this to basically inventory or something like that when you sell inventory. But it's going to be a little bit different in that when you have the equipment being sold from one to the other, it's usually only one transaction, right? Because inventory, you can have multiple transactions, multiple inventory. And the other thing that's involved here is usually we're considering the current year and the prior year for inventory, whereas for the equipment, we're considering whether it has been resold or not. Whereas for the equipment, note, we do a similar action in the year that it was sold. But this is now, of course, the prior year. So the prior year was sold. We're going to have the lagging thing that's going to be a problem, and that's going to be the depreciation that's going to result in the accumulated depreciation. We here are concerned with the depreciation that's going to be a result of whatever gain or loss that happened in basically this intercompany transfer. So we're going to come back to this after we consider the actual transaction. So let's go down the other side of this worksheet that I just want to fill in now. Will be the book value. So we'll say then we'll have the book value, which will be assets minus the liabilities for S here, or the 273,000, or in other words, the equity, same thing, 273,000. So let's pick up that number. So I'm going to say, all right, so this is going to start off with the total of the sum of the assets and the liabilities, and that's going to be the 273, which we would typically start off with the breaking out between controlling and non-controlling interest, that being the 70% of it. Controlling interest, non-controlling interest, that's 273, I'm going to say times 1 minus the 70% or 30%. These two, of course, adding up then to that 273,000. All right, so the next thing we typically will consider, and I know I'm not going in an order where this is the new thing, so I want to just basically point out this worksheet, and I want to kind of get that into your mind as a standardized type of thing. The other standardized type of thing we typically will do is the calculation of goodwill. So let's look at the calculation of goodwill. Then we want to consider the equity method and consider basically how P is getting to these numbers using the equity method, because these are key numbers we want to get to 0 when we do our reversing entries. So next thing, let's go ahead and take a look at the calculation of goodwill. Now you'll recall when you do this, you're going to say, hey, goodwill, do I need this thing down here that says goodwill was impaired? Impairment of goodwill? Not yet, because we need to first calculate goodwill at the point in time that this happened. In practice, of course, we would have already done this because this is 5 years later, but we have to consider this every time, we do the consolidation in essence. So we're going to say, all right, what happened at the point in purchase? The net assets were the 174, or the equity accounts were 174 at the point in time of purchase for S, the company being purchased, 70% purchased of. There's no difference between the fair value of the assets and liabilities at that time. Therefore, we're going to say the fair value is also the 174,000. We're going to compare that to the non-controlling interest, which is given to us here at the 67,500. The difference then, fair value minus the non-controlling interest, is that 106.5, and that is what you would expect to be paid if there was no goodwill. But of course there was goodwill because we paid, or P paid, 157.5. The difference between those two would then be the goodwill of the 51,000. So we've got the 51,000 of the goodwill. Okay, so now let's think about the new transactions that basically took place that we're going to have to deal with to fill in this worksheet here, and then we'll go into the equity method. There was a sale of land, and there was a sale of the machinery and equipment. So we're going to say, all right, let's consider what those sales would look like. I think it's useful to actually just write down these sales. And notice when you deal with inventory, you have to write down these kind of sales in like a general sense. Like this is what happened in total, because you could have sold multiple inventory at some point in time. But with equipment, notice you can go right into the GL and probably look at the actual transactions, because there's not going to be a whole lot of inventory of machinery and equipment transfers typically with as compared to, say, inventory. So let's first consider the normal kind of thing we would have to. What was the sales price? Sales price for sale of land. Let's consider the land here. And that's going to be, where was the land sale? This one. I'm going to make that green. Going to highlight it and make it green since we're focusing in on it. The sales price of the land was $19,000. So I'm going to be picking up the $19,000. And the cost then, we're going to say the cost is $10,000. So 10,000, I'm going to put that in the same column. I want that in the same column. 10,000. Let's put a little underline on that, and that's going to be then the gain. There's going to be a gain that was recorded. This went from S to P, so that's going to be an upstream transaction. There's the 9,000. Let's think about it in terms of a journal entry. What would happen with a journal entry on S's books, the one that sold it? We'd say, well, they would record cash. Let's say they sold it for cash here. Would be going up by the 19, and then the land would be going off the books for 10,000. We don't have to deal with accumulated depreciation, which is nice because it's land. And then you'd have this gain, which would be a credit, gains or credits of the 9,000. What would happen on P's books? Well, on P's books, they would say, well, we got this land and we paid for it. We paid land for 19,000, and then cash went down by the 19,000. That's going to be what you would expect to see on the books of P. So then we're going to say, all right, if you were to consolidate this thing as if P and S were the same company, you would think you just reverse this whole thing would basically have to be reversed. Let's think about how we could do that as efficiently as possible. What's the difference that we're talking about here? Well, cash is going to net out against each other, and then we're going to have the land. The land now is netting out between this and this, the difference being 9,000, which is of course the gain. And then we have this gain that's on the books, and that shouldn't have been there because we sold it in essence to ourselves. So this is basically, if you distill it down, kind of what the reversal should be. Now note that this gain is something that happened in the year of sale. So it's going to be recorded on S's books in the year of sale, which was 2000x2, and we're doing the consolidation now as of 2000x5. So that gain has rolled into, basically retained earnings on S's books and whatnot. Let's do the same thing for the machinery and equipment. Let's look at that one. Let's look at this one now. And just to mull this over, what we need to do here. It's a little bit more complicated for the machinery and equipment because now we got depreciation to deal with. But we got the same starting point. We're going to say, all right, well, what was the sale? Let's just calculate the sale on it. Well, the sale, we sold this thing for $37,500. Then we got to calculate the book value because there's going to be a depreciation involved here and the cost. So we'll say cost, the original cost, what we bought it for, which was like 5 years ago, $58,000. And then there was accumulated depreciation, and that was for, I'm going to say, this amount divided by, it's got 10-year useful life, and it says here we've had it for 5 years before this, so times 5. Now, in practice, of course, we would have that information, so, because we would have the depreciation schedules and whatnot, and we would know at the time of sale, we'd actually be able to look at the journal entry and see what was on the books for. But in any case, then that's going to be the book value. Book value then is going to be the difference of the 58,000 minus the 29,000, resulting in a gain of 37,500 minus the 29, or 8,500. All right, so then let's say, what would happen with like the journal entries? Like if we put this into like journal entries for P and S, just to consider what that would be, because we kind of need to reverse those in essence. So if we did a journal entry for P, we would say, we're going to say they sold it for cash. So that would be, cash would be going up for what they got, the 37,500, and then they're going to take the machinery off the books because it was on the books for 58, the full cost, because we have to take the accumulated depreciation off in a separate account because it's in a separate account. So then we got the accumulated depreciation. It's a credit balance account, so we got to take it off the books with a debit of the 29,000. And then the difference there is going to be our gain. Then that's going to be the gain. The difference between those, gain, negative sum, and that's going to be our gain of the 8,005. Okay, and then we could say, well, what would happen to, like, on the other side of the books, on S's side of things? Well, S would have said, we got this piece of machinery here, and we paid $37,500 for it. So cash went out for the $37,500. That's what we put it on the books for, that $37,500. So with this transaction, these two would need to be basically netted. These two would need to be netted out. We need to reverse them in essence. Well, how can we distill that down to its simplest form? Well, we know that this cash is basically netting out against this cash. So those kind of net out. And then we've got the machinery here, which kind of nets out to the machinery here, but it's left, there's still something left. So we're going to say, all right, well, there's a difference on the machinery that we got to deal with because it was 58 and 37.5. Then we have the accumulated depreciation, which we basically going to have to put back on the books because it shouldn't have gone off the books. And then we got this gain that happened. That shouldn't have happened if it was like one company selling to themselves. That shouldn't have happened. But note that, so that's going to be our difference there. But note again, this gain happened in a prior year. That the sale didn't happen in the current year we're consolidating. It happened in a prior year that we're going to have to deal with then. Now we also want to think about, well, what about like, now there's going to be a depreciation issue because now they're, S is depreciating the property at $37,500, which when it really only had a book value before of this 58 minus the 29 or 29. So we're gonna, and so the difference, of course, is the gain here. So it's now on the books at 8,500 more, which is going to result in excess depreciation. That's going to result, and that's going to happen every year after the point in time the sale happened. So now we've got the added book value. So the added book value, I'm going to call it, is 8,500, and then useful life, 5 years left, because we're saying it was 10 years property, 5 year past before the sale. So we're going to say it's going to be depreciated over 5 years. And so that means there's going to be depreciation per year, extra depreciation, this should be a 5, every year of 8,500 divided by 5, or 1,700. So every year after the sale happened, there's going to be an overstatement of the depreciation, we're going to say, of the 1,700. So in the current year, that's all that's really affecting the current year, because both of these sales took place in the prior year. They didn't happen in the current year of consolidation. So when we go back up to this little worksheet, really what we're concerned with is that 1,700. We're going to have to deal with some of that other stuff, but right now we're going to say, let's pick up that 1,700 and we're going to apply that out. That's going to be, it's a down transaction, so it's all going to be allocated to P. We're not breaking it out on a 70-30 breakout, and then I'm just going to sum these up, and that's going to be just our little adjustment to that first journal entry that we will make. So I'll make a little adjustment to that first GL for the consolidated according to this. So this will be coming back into play in the future shortly. All right, so there we have that. Same thing on the bottom, just like our tables we've seen in the past. So we started with net income adjustment, started with the book value, then the adjustment, ending book value here. So summing these up equals the sum and the sum. So there we have that. Okay, so now that we have this information, we're gonna go back on over here, and we want to consider the fully adjusted equity method, and we also just want to consider these two accounts. Basically, how are these two accounts constructed? So to do that, let's hide some cells. I'm going to hide from Q to T. I'm going to put my cursor on Q. I'm going to select over to T, QT, let go, right-click the selected area, and hide those cells. So then we've got the fully adjusted equity method, meaning we're going to do normal equity method and then do all the consolidation effects on, in essence, the income statement of S that will be a result of some of the factors that we have taken a look at thus far. So let's just think about the normal equity method first, and we'll see what we're going to try to basically reconstruct these entries. We're not going to post these. We're basically reconstructing these accounts, or at least this account and part of this account. Okay, so we're going to say first normal equity method stuff. Normal equity method stuff is we take the net income, which is this minus this, and that would be the 45,000. And P would normally record that with a debit to the investment account and a credit to the income from S. So that's going to be then, we're going to say negative of this, and we're going to take our 70% interest in it by saying this 70% over there, and that's going to be the debit and the credit. So there's the debit and the credit. Then we typically take our portion, or P's portion, of the dividends, 36,000. 70% of the 36,000 would then be cash would go to them, and the other side would be decreasing the investment account. So we're going to say, all right, so that would be then we would get this 36,000 normally times 70% of that. And so there would that be. And now we're going to do our adjustment for the little table that we made over here, an adjustment according to basically this table. So I'm going to say, all right, let's take a look at then, this would be the investment account is going to be the debit of the 1,700, basically the excess depreciation, and the credit going to income from S, which is basically, reducing our, so that's actually increasing. It's increasing basically P's investment in S, because we're saying that this number here is including depreciation that's too high. So basically that would mean this number's too low, so they're basically increasing their reflection of it here. So now if we do our little comparison, I'm going to say, all right, now let's say if I just add these up, income from S would then be this number plus this number, and that ties out to here. That makes sense. So what about the investment? If I go to the investment, that's going to be this number plus this number plus this number, and that's going to be 8,000. That does not tie out to here, because this has been accumulating for since the point in time that the purchase took place. So let's do a little worksheet here to actually come about this number, just to reconstruct it. We could say, how can we reconstruct this? It's been a few years now since the point in time that the consolidation took place. We can reconstruct this number using the equity method. Let's take some time and consider basically the reconstruction of this number. For that, we're going to go to our worksheet over here, and we're going to just take a look at this item. So we're going to say the net book value reported by S, or we could think about in the current year. So we're thinking about basically we're going to reconstruct assets minus liabilities, or we're going to get to that 273, or if you take a look at the equity side of things, the 273. So let's just let's reconstruct that over here. If we didn't have such a nicely formatted trial balance, that would be a more difficult number to come to, right? So if we had the common stock, I'm going to pick this up. I'm going to say, here's the common stock, the 120,000 for S. Then we're going to take a look at retained earnings. Let's do a quick calculation of the retained earnings. That's going to be the beginning retained earnings, which will be this 144. It's beginning retained earnings because we at the end of the day, we're going to close all the temporary accounts into it. We have not yet done so. Therefore, that is going to be the beginning retained earnings. Dividends also not being included because we broke them out. Then we're going to be picking up the net income. So the net income is going to be this number down below, which is going to be revenue minus expenses, Then we have the dividends. The dividends will be equal to this 36,000. That's going to then be, and let's make the dividends a negative so we can just sum this up. So that's going to be our retained earnings equals the sum of these items. And notice if you were to go over here, you could sum that up in a nice little worksheet like this. You could say it's that, and there's nothing in here yet. So basically all of this is going to be the 153,000, the retained earnings. So that's going to be the retained earnings. And then if we take all of equity then, The equity basically is that 273,000, which of course is the common stock and retained earnings, which is the 273,000. All right. Then we're going to say, okay, of that, what's our controlling percentage of it? 70%, which we're going to say is this 70%. So you would think then you would have the book value, assets minus liabilities at this point, times 70%, reflecting this number here. But obviously that's not the case because we have to make our adjustments to it. So now we're going to make our adjustments. And so first let's think about the land. So we had this land that resulted in this gain. And we had the gain up here. This is a gain that happened in the past. And note, again, we're saying, hey, look, the gain's not in the current year. So therefore, it's not something that affected our transaction basically here. Or it's not something that affected our investments, our income from S account. But it does have an impact on basically the balance sheet side of things, which is reflected on us for P in the investment. So we're going to say, all right, let's take that. Then we're going to say that 9,000 of the land gain, and we're going to multiply that times our percent, which is the 70%. And this is, I'm going to make it a negative because this is going to decrease. So I'll just put a negative sign in front of it. And then we have the downstream transfer of machinery and equipment. So downstream transfer of machinery and equipment. So I'm going to say, all right, here's the downstream. There it is right there. Now, because this is a downstream transaction, we're going to pick up that entire amount. So we're picking up the entire amount here. We're following, in essence, the same kind of rules we had in our table up top where we have the upstream and downstream transactions. So downstream, like this one, is allocated to P. Upstream transactions, we're allocating 70, the 70-30 for between the split between the controlling and non-controlling interest. Then we're going to reverse the deferral of the gain that happened in 2000 X4 because that means this depreciation over here resulted in a gain in 2000 X4 and 2000 X5 that we're going to have to be dealing with. So I'm going to break those out separately. You can add them together, obviously, but I'm just going to say, all right, there was this gain that happened over here. So I'm going to have to account for that. That's going to mess things up. And then there was another one, same amount in the next year for basically the depreciation that we're talking about. And then there was Goodwill. Goodwill was on the books at the initial purchase of the 51,000, but then it was impaired. The Goodwill was impaired by the 16,000. So that was an impairment loss. So the difference between the two is basically what the Goodwill is on the books for now. So we're going to say, all right, well then the Goodwill was that, but then it's going to go down by 16 to the 35,000, and we actually have to take our portion of the Goodwill because that's full Goodwill, controlling and non-controlling interest. So I'm going to say this is going to be times the controlling interest. So there's the 24.2, I think. Then let's sum this up, and let's sum that up, and then we've reversed into, note, this number here. So that'll help us to kind of back into this. So you can see that as time passes, you can see how these activities, you know, in the past will affect this. So we got to break out those things that are going to be affecting basically the income statement and the things that are affecting the balance sheet. We could do the balance sheet items or the investment from start to finish. We could have done the same thing, in other words, by starting with the initial transaction here and then recording all the things that have happened thus far, or we can take the end result, basically taking the ending number, starting where the net assets here, starting with the net assets here, or net assets, and then basically back into, because this number should reflect P's investment or proportion of the net assets after having to adjust it for, you know, the fully adjusted equity method after the elimination entries. All right. So now let's go back on over here and let's unhide some cells. So I'm gonna select from O to U, O to U, O, and then I'm gonna right click on the selected and unhide that area. And this is where we're going to be doing our entries. So we'll start with our standard entry that we have up top. So I'm gonna do the standard entry. We're going to say that's going to be the investment. Let's go ahead and sum this up first. This is P's trial balance. This is S's trial balance. We'll start off by adding them together. We add them together. This is the same process in prior problems. So we add that up. We're going to say copy, paste. We're going to add them up. That's our starting point. Then we need to do our elimination entries. So we're going to think about this one. I'm going to start it up top, and I'm not going to put anything in it yet. We're going to go down and, in essence, eliminate the equity portion for S. So I'm going to say, all right, that's going to be the common stock then. And then I'm going to copy and paste that down. And we're going to do the same thing for retained earnings and dividends. So, okay, this is a credit here. We're going to debit it then. We're going to debit it. I'm going to debit the 120 first. Debit the 120. Then this is a credit here. We're going to debit it. So I'm going to say negative of that on the debit side. This is a debit, so we're going to credit it to make it go away. So we're going to say negative of that. That's our standard process. Then the other account that will be affected will be the income account, the income from S. So I'm going to say our normal process here would be to take negative of the net income times our portion, or 70%, P's portion. We're P. We're P. We're the parent. All right, so there we are. Now, we're going to adjust that, however, because this is going to be adjusted to what is in the table. So if I look at our table over here, we're going to say, but what about our table? The table, here's the 31.5. We're going to adjust that down to the 33.2. So I'm going to say, all right, this is coming from the table. That's why it's green. The green means it's coming from the table. So there we have that. And then we usually have the non-controlling interest in S. Non-controlling interest in S. And normally we take this times the non-controlling portion, which is times, let's say, 1 minus the 70% or 30%. And it would be that 13. Now, I think this is going to be the same in the table, but I'm going to say anyways, we're taking this from the table. So I'm going to just say we're going to take this from the table, which would normally be this number, and it's actually the same. Whoop. That's not the one I wanted to change the color on. That's the one. It's going to be the same, but I want to indicate that we're taking this from the table. This is coming from the table. There's the table. That's where it's coming from. Then we're going to take the non-controlling interest in the net assets, and that normally is calculated as net assets, either this, that's the 273, or this 273 times the non-controlling interest. So let's do that. It would normally be negative, let's say negative sum of assets minus liabilities times, I'm going to say 1 minus the 70%, which of course would be the 30%. That's what we would normally have. And you can see that in our table over here. And it's going to be the same, but I want to take it from the table. I want to indicate, hey, look, we're taking this from the table. This is from the table. This one comes from the table over here. So I'm going to say, I'm going to make that one orange and say that's from the table. And then we have the one up top, which is normally calculated as kind of like the same number here times the controlling interest of 70%, or the net of this times 70%. So I'm going to say it, do it this way, negative sum of this times the controlling interest, or 70%. That's what we would normally do. But this one too, we're going to say this one, we're taking this from the table. So here's the table over here. There's where the number would be. There's the changed number that we want it to be. So I'm going to make it that. That's what I'm going to change it to. It's actually going to be a credit of that number. That's the number. And this thing should still be in balance. So it should still be in balance. So that looks good. Let's go ahead and post this out. So I'm going to go to the investment account over here. Investment account. We're going to post this out. So we're posting this one here. So we're going to say this equals the 192.8. Then we're going to go to the common stock. So there's the common stock. It equals 120,000. And then we're going to go to the retained earnings. It equals the 144,000. Then we're going to go to the dividends. It equals the 36,000. Note now that we have the parent equity section in essence, the subsidiary, adding them together. We then removed, in essence, the subsidiary, bringing us basically back to the parent. All right, and then we've got the income from S. Income from S is going to be equal to the 33.2, and that actually brings it down to 0. That's nice. That's what we want to see happen. So we're going to then go down, then this equals the 13.5, and then the non-controlling interest up top, non-controlling interest here is going to be equal to the 81,900. Okay, so that's the big one. So now let's go to the next one where I'm gonna post the goodwill. We are gonna post goodwill now. So note that the goodwill, we said, all right, the goodwill was on the books at the 51,000 when we originally consolidated. However, it was then reduced because it was impaired. It was impaired in 2000X4, which is last year. So it was impaired last year. So that means in the year of impairment, it would have affected the income statement, resulting in a loss. But that then would have rolled into the equity section. And so now we don't have to deal with the income statement side of things. We can basically just net these two things out and say the goodwill is going to go on the books for the net of these two things, you know, where it currently stands, which we would take from the prior year consolidation worksheets. And then we're just going to post the other side to basically the balance sheet side of things and not have to worry about the income statement side of things. So we're just going to go, all right, well then goodwill is going to be going up. We're going to have to record goodwill. We're going to make it go up by the original 51,000 minus the amount that it decreased by because of the impairment, which was the 16,000, bringing it down to the 35,000. Then we're going to be breaking that out between the investment and the non-controlling interest, the balance sheet side of things, not the income statement, not the non-controlling income statement, because this is basically balance sheet side of things in accordance with our percentages. So that 135 times the investment is going to be the 70%. And then this one is going to be, I'm going to say negative of that times, I'm going to do it this way, 1 minus the 70 to bring it on down to the 30%. Just so when you look at this Excel worksheet, you'll see, you know, I think that's a better way to look at it when you click on the cell to see what's going on with it. So then we're going to post this. So here's the goodwill. So goodwill, let's post this one, is going to be going up by the 35,000, increase in the goodwill. The investment account, so the investment in S is here. I'm going to say F2 plus F2 and scroll on over that 24.5, and then we got the non-controlling interest in NA, which is this one, F2 plus F2, and that's going to be that 10,000. So there we have that. Then we're going to record the land. The land's going to have to go on the books. So we got to record, you know, these two transactions that happened in the past for the purchases. Now note that once this happens, like we would see this, like if I did if we did a worksheet last year that was to put these things together, we would basically be able to see some of these transactions that happened in the prior year and just repeat them in the current year. So it's not like we would be doing this completely from scratch like we have to when we're doing a problem like this. You know, we would look at last year's stuff and say, you know, we got to do this entry again. So then we're going to say that the land is going to have to go up. So let's consider the land sale that happened. The land sale, you'll recall, S, and this happened in a prior year. So S sold it, so they said cash went up and the land is going down on their books. They had a gain. And then on P's books, they said they paid $19,000 and then cash. So the land is now on the books for the 19. So the difference between the two, the cash nets out, and we've got this land is on the books now for 9,000 too high, because we should never have had, it's now on the books for 19, it should only be on the books for 10. So land needs to go down. That's the first thing. I'm going to put it on top here because that's the first thing I would think of, even though it's a credit. So I'm not going to put the debits on top. I'm going to put whatever I feel like is the easiest way to look at it on top. And then the gain would be something that it would affect the income statement, but again, it rolled into the retained earnings, and this happened last year. So we don't need to deal with the gain. We could just go into the current year and say that we're just gonna record the other side, breaking out to the basically balance sheet accounts between the two, investment account and the non-controlling interest. So then I'm just gonna take the negative of that 9,000 times the 70%, and then we'll take negative of that times 1 minus the 70%, which of course will be that 30%. That being then the 30%. Now let's post it out. Here's the land. So land's going to be up top. Let's go on up top to do that one. Land is going to be decreasing by that 9,000 to get it back to where it should be before you made a sale to yourself. And then we've got the investment in S. Something's in it, so I'm going to say F2 plus F2. We're going to pick up that 6,300. Then we have the non-controlling interest in A. So that's going to be here. F2 plus F2. That's going to be the 2,700. Okay, so now we're going to do a similar thing for the machinery. So machinery, there was a sale of machinery that happened in the prior year, depreciable type of asset. Same kind of process. It happened in a prior year, but we still have to deal with the difference in basically the machinery and now the depreciation that resulted from it as well. So let's think about the balance sheet side of things that happened first. We're going to say, all right, well, the machinery. What happened with the machinery? There was a sale of machinery that happened last year, and it was like P made the sale for $37,000, so they recorded cash went up, and then the machinery went off the books, and then they had to take the accumulated depreciation off the books related to the machinery, and the difference was a gain of $8,500. Then S bought the machinery for $37,500, and they paid cash for $37,500. So then the cash will then net out like so. The machinery then is going to net out, leaving us with the $20,500. It's actually understated, meaning we have to increase the machinery even though there was a gain. Why? Because when they purchased it, they put it on the books at the cost of the purchase. They didn't put it on the books for machinery and the accumulated depreciation. So we actually have to increase the machinery. Then we have to put all the accumulated depreciation back on the books at the point in time that the purchase took place, and then we're actually going to have to depreciate it, since that time. And then there's a gain here. The gain is something that rolled over. We don't have to record the gain because it rolled over into basically retained earnings. We're dealing with the balance sheet side of things with this transaction. So we're going to say, all right, then the machinery needs to go back up because it's now too low because of that sale. So I'm going to say that equals, and it's going to go up by the net of those two items that happened. So in our little difference calculation, it's the 20,500, and that's going to have to be a debit. So I'm going to say negative of that number. And then the accumulated depreciation, it's all got to go back on the books because we get all the accumulated depreciation related to that sale. So this amount needs to go back on the books. It's a credit account, so we're going to increase it with a credit. And then we're going to have the accumulated depreciation that is a result of the depreciation after that point in time, meaning the next year's depreciation expense that happened. So we put the accumulated depreciation all back into full stature on the books of the 29,000, and then I'm going to record the accumulated depreciation that's going to reduce that amount for the year after this took place. In other words, the machinery, this happened 5 years ago, and then this happened in 2000 X4, and that happened in January. So we're going to reverse the accumulated depreciation, and then we had this 1,700 of depreciation expense that's going to be on a result of, or as a result of, the added 8,500 that shouldn't be there because it's basically depreciation expense on the added amount. So I'm only going to be looking at that for the prior year, that accumulated depreciation. I'm going to break it out in a separate entry so you can see it. You could net them together. So I'm going to have the same account right next to each other. And this is going to be decreasing the accumulated depreciation. So I'm going to go back over here and say, now we're going to decrease the accumulated depreciation by that 1,700. Okay. And then the difference here is going to go into the investment. So it's going to go into the investment in S. And this is going to be for the entire amount. Notice we're not breaking this out on a 70-30 split, not based on the controlling and non-controlling interests. And that's because it's a downstream sale from P to S, parent to subsidiary. So equal. So I'm going to say negative sum then of these items is going to be the effect on the investment account. So let's record this. We're going to say, all right, so the machinery had to go back up. Depreciable asset went up. Then the accumulated depreciation, I'm going to record two things in here. This equals this, and then this. And then we got the investment account, the investment in S, and that's going to be here. I'm going to double click on that, and notice that's what we need then to get back in balance. So I did something funny, something bad happened. Can I undo it while I'm in there? Yeah. So then I'm going to say the investment account, and that should bring it to 0. So that is nice. Okay, so then this accumulated depreciation records the reversal of the extra accumulated depreciation that took place last year. Now there was, let's record the extra depreciation in essence that took place in the current year, meaning in this year, this depreciation is overstated by 1,700, which we calculated before here. We said that's going to be this amount because now the equipment is on the books for the amount of the gain, which is 8,500 higher than it should have been for S. So they recorded depreciation expense on it, which came out to 1,700 of depreciation, which shouldn't have been recorded. So we're going to reverse our normal kind of depreciation entry, which would be debit depreciation expense, credit accumulated. Now we're going to debit the accumulated depreciation and credit the expense for that 1,700, for that 1,700 down here. All right, and so let's reverse that one out. Now notice we're doing something to the income statement, and you might say, well, now we got to do something to like the non-controlling interest and the income from S. We don't, because we took care of that in the first journal entry with this table adjustment. So we took care of that here with the table adjustment. All right. So then let's go ahead and record this. We're going to say accumulated depreciation, double clicking on it, going to the end of it, plus we'll pick up that item. Then the depreciation expense down below here, that's going to be equal to the 1,700, picking it up. Lastly, we're going to do that intercompany transfer where we said that there was an amount, let's say for accounts receivable, that was in accounts receivable for P, 5,000, that's from S, and there's an amount in accounts payable that is owed to P. So we're just simply going to reverse those. We've seen this multiple times, easy thing to do, but notice a lot of these things aren't too difficult in and of themselves, but when you start to add them up on each other, they can get somewhat confusing. Obviously, if you were to do this for multiple years, you could see that we have to do some of these things every year. so it gets to the point where you got to be able to just break out a lot of things that are not difficult in and of themselves, but when you put them all together, they can be. So note, you also might be thinking, what about inventory and whatnot related to the receivable and the payable? We can often think about those as a separate thing. So the inventory could have happened at a prior year or something like that. We will typically think about, let's reverse the reciprocal accounts and then any other accounts related to them, possibly pull those apart and think about them kind of separately. So this part is easy then. We just say, all right, well, this is overstated by that. And this is overstated, so we're just going to say whatever it's overstated by, we're just going to, which the book gave us, or the problem is going to give us here, I'm giving you, at 5,000. So there's going to be the debit and the credit. So let's go ahead and record that we're going to say, okay, the accounts payable is then going to be decreased by the 5,000, and the receivable is going to be decreased then by the 5,000. And there we have it. So notice we're back down to 0 here. You can see our equity section has been, we basically removed S's equity section. So we are in essence back to the equity section reported by P there. Those are some of the check figures that you can take a look at.